think of the companies that have been most successful that I've sort of seen as an investor, the path to success was rarely kind of a straight, curve up and to the right. I mean, there were little bumps along the way. And I think it's being able to really kind of pay attention and support companies through those bumps that makes a huge difference.
Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay Ventures. On this podcast, I interview innovators about their strategies, industries, and decisions. Before we jump into today's episode, I wanted to give you a few quick business updates. First, check out Thunder.vc. It's a new passion project of mine, a platform that matches founders and investors in a respectful way. In my opinion, it's got to be the easiest way to tap into hundreds of fantastic venture funds and angels. You can reserve your handle at Thunder.vc before it's gone. Also, our incubator is accepting applications. Our program is super active at this point. It's not an accelerator. If an accelerator is a classroom format, our program is more private tutoring. You can find out more at interplay.vc. And on to today's episode. Today we have Josh Stein, the managing partner of Threshold Ventures, a mainstay OG VC firm in Silicon Valley. Before joining the VC world, Josh was an entrepreneur himself. And during the conversation, I labeled Josh the Empathic VC, which I think has really shaped and molded not only his business relationships, but the strategy of his firm. We discuss a ton in this episode, including the impact of COVID on operations, global fund strategies, the pros and cons of blending growth and early stage funds, dynasty funds, and a lot of advice for up and coming VCs. I hope you enjoy. This episode is brought to you by Bowery Legal. Bowery Legal provides a complete range of legal services to high-growth companies. They do everything from formation, employment, partnership agreements, stock grants, corporate matters, and venture capital and debt financings. If you're interested in learning more, visit bowerylegal.com. So, welcome, Josh.
Thank you.
Great.
Good to be here.
So I'm going to start with doing your interview for you, or your intro for you. I feel like I don't want to leave you with too much time to burn telling your story, so we can get into some more complicated conversation. And also I can brag about you a little bit in a way you probably won't. So for those who don't know, Josh Stein is the co-founder and co-managing partner of Threshold Ventures, which is an institution in Silicon Valley. He's had a traditional VC career path when it goes super well. That's the right way to describe it, I think. So Dartmouth undergrad, Stanford Business School, BCG, Microsoft, numerous startups. And then he landed at DFJ too many moons ago. And that's where our paths actually crossed. When we were at DFJ, I was a young VC and Josh would swoop into New York for a board meeting and he would inevitably lend some wisdom to me on every visit, which I was very grateful for. DFJ transformed into Threshold Ventures, and Josh has been very successful. For those who don't know Josh or aren't familiar with him, he's on the board of a bunch of major companies, investor in a bunch of major companies, on the board of Box, investor in companies you've heard of like Chartbeat, Lenke, Twilio, Yammer, and the list goes on. He's an absolute veteran, and I would say at this point, OG Silicon Valley VC with a lot of wisdom to share. Josh, what did I miss?
That's a really nice way to say I'm old. But thank you.
Well, as we were just talking about, I'm catching up to you, unfortunately, too quickly. So here we go. So I want to jump in and start on the VC side of the house, where I want to spend a lot of time today with you, particularly given your background. Before we kind of go into some VC topics, I would love to get your version of Thresholds, just a baseline level set for folks. Mind telling us about the firm?
Yeah, absolutely. So Threshold, we're a early stage venture firm, sort of notionally based out here in California, although, these days, I'm not sure location matters quite so much. We try to get involved as the first institutional investor with companies. So what that means is we're typically joining as like the first board member, a lot of companies post seed funding, but before the funding becomes more sort of transactional. So we're typically leading Series A rounds, $5 to $15 million. We'll write a check of anywhere between $5 and $10 million, typically initially, and then we tend to be very active, engaged investors throughout. So one of our beliefs is that particularly at the early stage when things can be in flux, it really helps a lot to have at least one investor that's really kind of engaged, paying attention, kind of really, immersed in the details of the company. Then as the company scales over time, we continue to support them over time. So as other board members, other firms come in as companies raise additional capital, we don't kind of step back. We tend to stay all the way through, to IPO and in some cases beyond. You mentioned Box. I actually just stepped off late last year after 14 years on that board.
That's a long time.
So we have these these really long kind of engagements, and we invested in every round all the way up to the IPO. So from when it was just 3 people, all the way up through and the valuations were in the billions.
And so for folks listening, that's a little bit unusual. I mean, most VCs who are coming in, they write a check in a round. Maybe they have some reserves to follow on the next. But very few funds are life cycle funds where they're deploying capital as a primary investor all the way through. So is that the core strategy? Do you do that for every company, or is it something you do in some occasions?
Yeah. So the Threshold is a spin out, as you mentioned, of DFJ. So it was founded by a team from DFJ, and we worked together for a long time. I actually was a DFJ entrepreneur. So I started a company. DFJ led my Series A round back in 99. And Threshold was really formed out of kind of all of those experiences. And one of the things that we really learned about ourselves, but also about how we thought we could be most helpful to founders, was this concept of not making lots of small bets and kind of spreading ourselves too thin, but really kind of being intentional about where we wanted to place our time and our money, right? And so, to put it in like some numbers, like we have 5 partners.
Mm-hmm.
We will typically make, call it 7, 8 investments per year, and we won't typically be working across the whole firm with more than 50 or so companies. Those numbers may sound large, but in venture terms, those are actually really pretty small, particularly these days where firms have gotten really big. So, DFJ had been a much bigger firm. So it had, a lot more partners and capital and strategies. And, one of the things that we found is that, we felt that kind of spread us a little too thin. And so we really wanted to be able to focus very intentionally. And that's what we've sort of done with Threshold. You mentioned kind of the life cycle approach. I think that's a benefit both to the founders that we work with, because we want to be kind of that trusted partner and sort of that, that first call, not just at the beginning, but also kind of over time, but also from the LP side of our business. So the investors in our funds, we're typically investing more than half of the capital in our funds, not in the first round, but in subsequent rounds.
Mm-hmm.
And so if we're doing our job well as investors, we're building more, conviction in which companies are the best opportunities over time. So we think, that first investment is always a bit of a leap of faith, right? But if you're investing in a company you've been working with for 5 or 6 years, you have a pretty differentiated view on that opportunity. And so we find that's also a real driver of performance for us.
Yes, you have an information advantage. Now, there are firms out there that take this to the extreme, and they try to do every dollar into the company. They don't syndicate. And they write a $5 million check in year A, but they want to do 20 in year C, and they want to be the dominant source of capital for the company. Is that the strategy here, or is the strategy to continue to participate, which is very different, which means for folks who are less familiar, that other firms will maybe lead or meaningfully participate in future rounds, and so you'll have a diversified investor base?
Yeah. So, I think there's capital and there's also, kind of effort and time. And so one of the things we found is, you want to have more hands on the oars, particularly as companies scale. Different firms have different networks, different expertise that they can bring to the table. And so we think it's in the company's best interest to be able to partner with multiple investors over time.
Right.
And so we've sort of built our strategy to fit around that. So we want to stay engaged and stay relevant all the way through. We're often, if you look at a company at exit, at IPO or M&A, we're often, other than the founders, going to be the largest investor by ownership on the cap table, but typically pretty far down the list by dollars by the time the companies have raised maybe a couple $100 million or something like that.
Right.
And so I think the problem with the strategy I think of doing every dollar in is I think it comes at a cost, which is if your fund's a couple $1 billion, it's really hard to invest a couple $1 million and think that's going to sort of move the needle for the fund. And so we want sort of every dollar to feel like it matters. Mm-hmm. And it's why we also don't make tiny little investments. Like we don't, they used to call it sort of spray and pray,
right?
And where you'd make lots of little $200,000 investments. We found those just didn't, $200,000 you can have 100x, and it's still not that much money in dollars. And so we just tried to be more. It's sort of being intentional and focused in everything we do.
Interestingly, I had Ian Sigalo on the show last week, and we were talking about his strategy at Greycroft. They have a similar thing in that they deploy early stage capital and growth capital, which I think is a little different than what you're describing. You're talking about continuing to participate in a meaningful way in rounds. He's talking about coming in with a $30 million check in the C. And his comment was they actually divided the firm into two, because at the growth stage, the early stage dollars didn't move the needle. So how does it balance out for you guys? You're doing about 50% in the first Series A check. And so the follow-on dollars, they're still meaningful? Is that the concept? How does it work out?
Yeah, I mean, I think if we're doing our job right as investors, again, from the LP side, if you look at the fund but also if you look at the fund at the end and you stack rank the companies by kind of outcome in terms of the gains that were generated, you'd ideally want to see the investment costs also follow a similar pattern, right? So you had the most money in the best companies over time. I think you also, though, balance that as investors, again, being real committed partners. We work with all of our founders. I mean, you'll spend, as a venture investor, you'll spend a lot of your time and a decent amount of your capital on companies that are not the ones that necessarily go to the moon, but you want to help everyone find kind of the best outcome that they can over time. And so we support almost every company we invest in, I'd say, through multiple rounds, but we also do try to concentrate the capital over time in what we think of as the most, kind of compelling opportunities. With the multiple strategies thing, I think I definitely see the pros. I mean, you need growth. I think you need growth stage investors because, it's a different skill set underwriting an investment. When a company has lots of data, if you have 1,000 employees and 100 million in revenue, there's a lot of data.
Deal structure is slightly different. Everything's different.
Totally.
Yeah.
Yeah. Oh, absolutely. Right. So I think there's definitely a thing for that, or a need for that. I think the question I would have is why be a single firm at all, versus why not have those as separate firms? And that's where maybe we differ with sort of some of the conventional wisdom.
Right. So at your core, Threshold is an early stage investment firm that meaningfully participates. I'm sure it sounds like you participate more with the companies that are doing well, but you guys invest your operational resources and your time across the board regardless to be a good partner. What does that mean for an entrepreneur? Let's say an entrepreneur comes in, let's say they've got a hot company and they've got options. Why do they pick Threshold? Why is your money the money that they should be grabbing?
Yeah. So, the thing that we always encourage founders to do is talk to our other founders, because that's like it's do the references on us.
Mm-hmm.
And I think what people will hear pretty consistently is that, that we're kind of the people that are the most engaged and sort of most active with the founder. So because we don't work with a lot of companies, it allows us to really focus that time and attention. And I think that, at the early stage, I don't think you need like to be if you're a founder and you're 10 employees or 20 employees and you're in that kind of scaling process, you don't really need to be working with like a dozen investors. What you really need is, I think, one or two that are really kind of engaged and paying attention. And those conversations tend to happen pretty frequently, right? As opposed to kind of in a late stage company, you might have a quarterly board meeting, right? And it's more of an organic process kind of at the early stage.
Picking up the phone and coffees, and that's more what you're describing, right? Less of formal board meetings and PowerPoints. And so what kind of things are they coming to you for? Is there a pattern, or it's just all the typical operational stuff that comes up from HR to sales strategies? Is it all, or is there a thing you guys specialize in that you want everyone to know about?
I think for us, it's kind of everything. But one of the things we tried to do with our team is also have different skill sets among the partners. So for example, at Threshold, I tend to focus on the go-to-market side and I'm on the sales and marketing. And so there's companies where I lead the investment for the firm, but then I'll also work with founders where I'm not the lead partner, but I'm helping them with their go-to-market. One of my partners, Heidi Roizen, is probably one of the most experienced board members in Silicon Valley, right? And so she has kind of that perspective. My partner, Emily Melton, is one of the deepest in healthcare and healthcare tech in terms of that industry structure, which is something we've been, about half of our portfolios related to healthcare tech in one way or another, because it's a massive market undergoing huge transition right now. There's kind of incredible opportunities there, and so we try to really kind of have different skill sets within the partnership. One benefit of having a small team and a small portfolio is also that all of our partners can know all of the companies and vice versa, right? So when I was a founder, I worked with a number of firms. They would typically have 100 to 200 portfolio companies or more.
Right.
And it wouldn't be uncommon for me to run into like a GP at one of those firms at an event, and they'd invested, $10 or $15 million in my company, but they would have no idea who I was.
Mm-hmm.
And that always struck me as kind of strange. And so, we try to have more of this kind of, there's a cost to scale, right? On the investing side. So our strategy, the internet of our strategy is I would argue it fundamentally doesn't scale.
Mm-hmm.
Which is ironic because we're looking for companies that scale, but we're okay with that. We've kind of said, to do what we do and to do it well, it's not something that, we're never going to be the biggest. We just want to be the best.
Mm-hmm. So you're really focused on generating returns, multiples, and having positive impact to the entrepreneurs.
And I'd really stress the latter. I mean, I think the returns come. Like if you pick interesting opportunities and good people to work with, and if you apply, the right effort, I think the returns come. I think that the kind of joy we take in the business is really working with the founders, and at least, I'll speak for myself. I mean, that's really, when I look back, as you kindly pointed out, on a lot of years.
You're welcome.
It's not the numbers that get me excited. It's like having worked with founders and watching them build the stuff.
That resonates. I mean, you're an entrepreneur, right? Like you've been doing stuff on the operating side before. You didn't come at this directly from consulting with only a consulting background. So I understand why I think that there's an allure.
Well, you're kind.
Yeah, it's your DNA.
I wouldn't say I was like a great founder or anything. I mean, I think I'm a better investor than I was a founder. But I think it'd be really hard to be a venture investor without having spent some time at a startup. It's possible for sure. Like there are definitely people who, if you start really early in venture and you're meeting lots of founders, you're going to lots of board meetings and stuff, I think you can absolutely pick that up. But I think coming like right from like banking or consulting would be really not a great idea. You'd ask about kind of the sort of types of, one thing that's really interesting in venture is, the founders are always going to be much deeper in the technologies and the industries and the companies than they were. Like when I was running, my company, it's like, you eat and you wake up and, all you're thinking about is the one company. As a venture investor, you're broader, but you're also shallower. But the interesting thing, those two perspectives go really well. So, like if, let's say the VP of sales quits.
Right.
That may be the first time that founder, is probably the first time that founder has dealt with that. I've seen that half a dozen times.
Right.
And each situation's been different, but I can sit down with the founder and say, look, okay, I've seen this before. Like, here's kind of what we did at these things, and here's what worked. And by the way, you can call, you call Aaron at Box and, ask him how he handled it. This kind of thing. And that I think tends to be the kind of really helpful value add that we can bring. But I think also recognizing that it's not that we have like better information at all. It's a different perspective. It's like, as an investor, you're kind of the shallow and wide versus the really deep and intense.
I appreciate the humility in that. I feel like when I first started out in venture, I think the misperception I had when I'd encounter a lot of other young investors that a lot of folks had was that they thought because people were asking them for money and being very nice to them, that there was an assumption that they actually knew more. I think it's very rare for a VC to know more about an industry than the entrepreneur. Very rare. But the idea.
Oh, I think. I mean, if that's the case, then that's probably a problem.
Right. It's the pattern matching and general operating skills that I think apply. So when you've talked about, let me take this a different direction for a second. You've got a very unique strategy in that you're very focused on very few things. And as you've mentioned, it's not super scalable. And I go on a tangent here for a second. I think one of the limiting factors in scaling venture funds is board seats. We can talk about that if you're interested. But when I look at this, it sounds a lot different than the iteration of the firm before. Do you want to talk about how the strategies evolved from back when it was, I know it's a while ago now, when it was DFJ, and what you learned from that and why you've taken this current approach?
Yeah, I mean, I think, I think the, DFJ, I think really had a vision of kind of, applying, they've done really well for themselves.
I think you need to apply. I think it would be helpful to maybe start with an overview of DFJ. I bet you.
Sure.
Not everyone knows
so
the scope and scale of the firm, which was massive.
Yeah. So DFJ was founded by Tim Draper in 1985 when he was a really young guy. And Tim is a legendary investor, huge personality, very bold thinker, bought $20 million of Bitcoin at $600 a Bitcoin, with his own money.
For the win.
I mean, that's a pretty spectacular bet. But that's pretty typical Tim, right? He's bold, he's sort of fearless, and he's also, kind of like, he'll climb one hill and then he wants to climb a bigger hill and bigger hill. And, he'd been very, very successful. And, I think his vision was to sort of bring venture capital globally to, kind of every corner of the world and every sector. And I think I completely agree with the idea that, there's entrepreneurs everywhere and opportunities everywhere. I think, at least, my observation was that the executing that operationally was challenging,
Mm-hmm.
and that the things were lost in terms of the ability to really work closely with the entrepreneurs. When you have 400 portfolio companies as the managing partner, it's really hard to even know what all 400 of those companies do, right?
Mm-hmm.
And so it's not that strategy was right or wrong. It's just there was a group of us that said we really want to go back to kind of being able to work really closely with the companies and not have the partner meetings be kind of all day Monday where we're kind of covering the whole empire. And we kind of took the venture part of the business and sort of extracted it, and the U.S. venture part, and kind of focused that. The growth stage investing team, DFJ Growth, which is
still active,
which
right?
is a fabulous.
Yeah.
Oh, very. I mean,
they've done
not
very
just
well.
active. I mean, they're one of the best growth stage firms out there. They've absolutely crushed it. They had always operated pretty independently, and we we're still very friendly. But we kind of said, look, if there doesn't really make sense for us to be a single firm. Like it's, we should be kind of affiliated, but not this kind of tight line. And so, we sort of kind of spun out the firm in 2013, 2014, and have been sort of Threshold since. The name Threshold is newer than that. We spun it out initially as DFJ Venture, which was sort of a small,
like a half rebrand.
Smallish sort of change. Yeah, like a half rebrand, and then we kind of decided to do
your strategy shifted
the full rebrand.
So you've been operating under the new playbook for about a decade.
Yes. Yeah. Oh God, that's funny. I didn't think of it that way, but you're right. It's almost
you're
a
welcome.
decade.
You're welcome.
Thank you.
Okay. So, but just for people listening, just a little clarity. I mean, the DFJ network at the time, when I joined, which was 2006, I worked at the East Coast satellite, was sprawling. I mean, I believe there was 150 GPs. I believe it was the second or first or second largest firm by deals invested per year in the world.
Most years, I think it was the largest.
It was enormous.
There'd be a few. Yeah, it was enormous.
I
don't think it would. There are firms that are bigger now, right? Like if you think about like a Sequoia, for example, like they have offices in India and China and growth and early stage.
Yeah.
There's a lot of different strategies and people. But yeah, it was really, really big.
And the DFJ approach to it back then, if I remember correctly, was a bit of a franchise model. It'd find a local partnership, partner up with them, bring access to capital and knowledge about the industry, add platform value, and implement the network that way. That's different than what we're seeing Sequoia and other firms do with their global offices, I think. Is that right? Or is it, are you seeing, because it feels like that Tim was a trendsetter, right? He broke new ground in trying to be global about venture, which I think has come to fruition. It's become a reality if you're looking around at what's happening on the innovation front now. But when I look at the model, did the model persist, or did people take a different path as they looked at global expansion?
Well,
if
I think like many
franchising
things,
or building proprietary funds and other geographies.
It's more nuanced than that, right? But it's, so the question would be like, do you raise the capital from a single process, from a single set of LPs? Who makes the decisions ultimately, right? Like, do you have like a kind of a senior set of partners at the global level that have maybe like an override authority? That how do the economics
investments work? You mean?
But the gist would be like, I think you see this a lot just in general in business, which is there's someone who has that initial first idea, and the first iteration is sort of directionally right, but not perfect, and then it gets iterated. So you have like Friendster, right, and then MySpace, and then finally Facebook, right? And I'm sure there'll be, something after that. I would argue that DFJ's model was kind of the first. The idea of going global, of having all these offices and all these GPs, was just like thought of as crazy in the industry. And if you look at it now, that's where a lot of the biggest firms are. And I think they've taken their own twists on it and evolved it. And I think they're probably, I've never seen, by the way, the venture industry in more transition and flux than it is right now. Like everything is changing so dramatically. But I think that, I think it's not exactly the same as the way the DFJ was. But all that said, I think, we still believe that, being focused, I think there's, it's inarguable that there's an overhead that comes with managing scale. And there's pros that come with that. And I think when we, with most of the companies we work with, we'll ultimately raise capital from one of the, call it platform funds over time. And I think actually our model works extremely well with them because we're a small fund size, which we do very intentionally. We may own, 15% of a company or something, but when they're raising $200 million, we're not going to write a $30 million pro rata check. And so we're not kind of crowding out, the platform funds there. So we actually, it's easier for us to co-invest, or for a platform fund to co-invest with us, than it is with another platform fund, where they're both looking to, kind of do super pro rata and jam in as much capital as possible.
Right. So you've got the early stage guys, you've got the growth guys, you've got the firms that do both under one roof, and you've got the firms, I believe, like Foundry, where they try to do every dollar in the company. Very different models, very different approaches. Jury's out, I think, on which works, and probably the jury's out on which works for which GPs. Because if you can get the bets right at the early stage, I bet you every dollar in is a great way to go. But it's hard to do.
I think probably all the model. I think you nailed it, which is for which GPs. I mean, I think it's really dependent on the personalities of the people. Although, one thing if you look at like private equity, right? Or hedge funds, as they became much bigger, more institutionalized, I would argue they became much less about the personalities of the people. And they became, more like corporations themselves. And I think some venture firms are starting to look like that. I think, but I think, what we do and sort of the roots of the industry are more in these sort of, you really have at the end of the day, 5 to 10 kind of people that are sort of making the decisions at most of the funds historically. I think there's a lot of pros that come with that in terms of, being able to be nimble, being able to, there's a lot of leaps of faith and kind of intuition in venture, right? So there's, things like COVID happen, right? And, you have to kind of, really kind of sit down and go through the portfolio and say, okay, what are we going to do about this? And what's our perspective? And some companies maybe were fundraising right in the middle of that. And, the processes just, the market sort of shuts down for a little bit, but they need capital. So you've got to sort of step in like on an emergency basis. I think being able to be small and nimble really helps there in a way that it would be harder if you were bigger and institutional.
So let's take a different tact with the same conversation. I know when during the transition, even before you guys spun out and became Threshold, you had major fundraising responsibilities for the firm, if I'm not mistaken. How is it? What did you learn, and how has it differed raising for a large platform fund, to use your language, versus more of a boutique size fund? And I don't know, how much money do you guys manage now? What's the current fund size?
So we typically are like in the 200 to 300 million range per fund. We're about 800 million of AUM in total.
That's fantastic. So for that size firm, I'm sure it's a lot different in the way you're presenting it in the conversations. How does it change for fundraising? Is one easier than the other? Have you seen any major on the LP side? And the reason I ask is probably a lot of early VCs are going to be listening to this. For the people who are coming up, what should they be hearing and learning?
Oh, I mean, there's fundraising. It's a whole thing. We could talk about that. I think I don't know one's necessarily harder than the other. I think you're talking to different investors. One thing that we've had to deal with a little bit is some of our investors, the limited partners, have gotten when they started working with us 10 years ago, they were a certain size. Now they're much bigger because the market's been huge and a lot of capital's come in. And so as they've scaled, like it's kind of the problem they're taking with the big platform funds. Like we can only take so much capital per LP, and that might have been 1% of their assets 10 years ago, and now it's 0.25%.
Oh, interesting.
And
so have those institutions sized out for you? Like they're too big now, and you've gone to smaller institutions that are more appropriate, or Do they like the fact that they get more diversification? They can invest in you and 20
generally,
other funds.
Yeah, generally we've managed to hang on to those folks, but it's kind of a constant tension. And at some point, you can sort of see that that's going to be an issue. But our kind of view is as respectful as I am of that constraint and that problem for you, like our strategy works with this amount of capital.
Right, we're trying to make you money.
That's what we think that if we took more capital, I don't know that it would. I believe that at least the way we're currently configured, it would make yield less results for them. I don't know if there's one perfect solution in venture. I think there's lots of different ways to solve the problem. I know, for us that this is the way that we like to work, and I think we've shown that it's both effective, but also, for us, it's personally rewarding, right? And lets us kind of work the way we want to work.
What would be a tip you could give folks listening who are maybe on their first or second fund early in the process? You're a veteran fundraiser who's done it in a bunch of different ways. You've had the opportunity to pitch institutional LPs. A lot of the folks who are working through family offices aren't at that level yet or ever. Any words of wisdom for the folks who are learning and kind of coming up? Because, the next generation is being groomed right now.
Probably the biggest one would be these are long relationships, and you have to be, I think, respectful of the fact that, so with most venture funds, limited partners are committing effectively to a blind pool where they're going to have no ability, they have no say over decision-making of how that capital is invested. They have no ability to withdraw their capital. Really, it's a huge leap of faith on their part. And the funds are typically 10 years with extensions. And realistically, most venture funds have gone significantly beyond 10 years. If you put yourself in their shoes, like that's a big leap. And so I think it takes time to build those relationships. I don't think that I think that it makes the fundraising for companies, which I think is from a founder standpoint, can often be a painful, feels like a long distraction. It makes that look like kind of a cakewalk in some ways. So I think, typically we have relationships with LPs that go back, multiple years where we've been talking to them and sort of explaining our strategy and kind of talking about, the companies we think are interested in our views on the markets and the world. And you build credibility through those conversations. And then I think when ultimately then they choose to invest, it's because they know you and they have a conviction and sort of like, you do what you say you're going to do and that you're more right than you are wrong in the things that you say. Mm-hmm. I think that, having the patience to build those relationships over time and not being in as much of a rush is really helpful.
How long does it take?
The other thing I think is
when you're saying over time, are we talking 6 months or 6 years? What should people expect who are coming up to this process?
I think that it depends on the types of investors. So I think with there are some investors that are funds themselves, like fund of funds, and some of our most thoughtful LPs are those, like because they work with they're managers themselves. They work with lots of venture investors, like the folks at Top Tier, for example, in San Francisco have been longtime supporters of us. They're super engaged. They're probably more willing to take a risk on somebody that they've known for maybe 6 months or something like that. And then there's like pension funds and family offices where it might be longer, right? Or endowments where they might want to watch you for a couple of fund cycles. And so I think you have to kind of time your approach to the type of LP and understand sort of where they're coming from. But I think LPs in general, I think the way a lot of them are compensated and rewarded, they don't necessarily get as many accolades for the picking well as they do take risk on picking poorly. So, they tend to be a little bit more risk averse. And I think just sort of being kind of empathetic about where they're coming from and helping them, even just showing that you understand where they're coming from, you're being respectful of that, I think goes a long way.
How can how can a fund strategy or messaging be packaged to recognize their perspective? What are the things when you say you want to be empathetic to a built-in propensity for risk aversion, how do you placate that for them? You talk about downside scenarios. Is there some slide you use? What's the piece that illuminates that understanding?
I think that the in venture, at least in my experience, the sins from where I sit as sort of the GP side, the sins of omission are more than the sins of commission, right? So it's like the deals that you didn't do, or the having distributed or sold companies too early has cost us way more money than the bets we've made where the companies failed, for example. I think with that said, so you could argue, hey, it's all about the winners and the upside, and sort of just sort of go for it, and if you don't make it, you sort of die on the beach and move on to the next thing. I think that's not really how LPs think. So I think with LPs, and I think they have a point. You want to talk about risk mitigation and how you think about having kind of controls, and how you think about recovering partial. It's a lot of GPs are like, I've invested $10 million. I don't really care if it's 0 or 5, that I get back. I'm playing all for the 100 pluses.
Mm-hmm.
And that's the right strategy in some ways. I don't think that's actually a great message to either LPs or, interestingly, to founders. Because if I'm a founder, I'm thinking, okay, well, so you're saying if I'm not a 10X for you, you don't care? Like,
right.
That's not great either.
This is my life's work for 10 years.
Yeah, as a founder, I've got a portfolio of 1, right? And so I think on both sides, just kind of being a little bit more thoughtful about, okay, how are we going to, I would argue most good GPs spend probably more time with companies that are ultimately, kind of marginally successful, or maybe don't even return capital, and finding the, good outcomes for those, relatively good outcomes for those companies, than they do on making the best companies even greater. Because the companies that are just kind of going to the moon are sort of going to the moon, right? You're sort of along for the ride. I think you build a lot of your reputation actually with how you handle your investments that struggle. And can you help them find, some kind of, respectful, relatively good outcome.
There are VC sages out there that will say, hey, that's not where you should be spending your time. You should be spending time trying to help maximize the upside on the big ones. Right? There's some conventional wisdom that floats around VC that the dogs take all the time. And the subtext to that is that's not where you're supposed to spend your time if you're ruthlessly focusing on returns.
I mean, at some level, they're not wrong, but they are, right? I mean, it's I think if you're a founder, do you have, I don't know, like I think having somebody who's just utterly ruthless as my partner, especially when it's my only maybe investor partner, not such a great idea. I also think it's short-sighted. I think people kind of fool themselves like that, that you can even sort of know. I mean, the number of I think of the companies that have been most successful that I've sort of seen as an investor, the path to success was rarely kind of a straight, curve up and to the right. I mean, there were little bumps along the way. And I think it's being able to really kind of pay attention and support companies through those bumps that makes a huge difference. One of my companies that's doing best right now, the founder early on had a tough month, and she kind of came in and was really concerned about it. And I said to her, look, if in a couple of years you're going to look back, and like when you look at the graph on revenue, you're not even going to see this blip. Like it's like, the scale is going to have changed so much on the y-axis. Like it seems like a big deal now. Trust me, like you're not even going to notice this thing. And I think like that's, that I know that made she's mentioned to me a number of times, like that, like kind of helped her sort of just contextualize and kind of relax a little bit. But I think it's true. And I think, if you, the problem with being like ruthless and sort of, always optimizing is I think you're going to actually optimize yourself out of a lot of successful outcomes. And I think you're also going to piss off a lot of people along the way.
Hearing everything you're describing, it sounds like the whole strategy, the approach, the perspective is all hinging and centralized around empathy in a way that you don't usually hear from business people, let alone, most of the VC community. Sounds like you're taking an empathy towards understanding the LPs and empathy towards understanding the entrepreneurs. And I've actually made some hard decisions to forego scalability to actually construct your model to service the entrepreneurs you're investing in rather than just capitalize on them. And that's lovely. I think it's something we don't.
Well, it's a cool way to put it. I mean,
but I think it's coming through. I think it's the subtext of this whole story. I mean, I think if we're going to put a title on this thing, it's going to be Empathic VC. God. That's where I think this is going.
Well, I'm not sure I'd put myself in that. I mean, I
does that sound right to you? I mean, it's.
I mean, okay. It sounds a little. Maybe I've. I mean, we're doing it also because we think it's
and flowers in my interpretation of this. Tell me.
Well, I think it's what makes us want to do this and get out of venture's a long haul, as you know. I mean, I've been doing this 17 years.
Don't admit it.
Yeah, well, I got another 10 or 15 in front of me, I think. I mean, so it's and you work with companies for 10 plus years easily. So, you got to, like founders, I mean, you got to want to kind of, we have a much easier, I think, role than founders do from a kind of emotional toll and stress standpoint. But I think you still have to want to get up every day and do it. And, so for us, we've really built the strategy around what gets us out of bed and makes us excited. And also, I think it's what do we think is going to generate the best returns? One thing about scale is I definitely think there are strategies we could follow that would make more absolute dollars of gain than what we're doing. But I think we care a lot about performance. So for us, it's knowing that we've delivered superior returns to our investors, not just, I'd rather make a 5x on 2 or 300 million than I would make, a 2x on 2 billion,
right,
even though the latter would be more dollars.
Right. And there are people who definitely choose the latter because they are optimizing for that. And there's nothing wrong with it. It's just a different strategy.
Nothing wrong with that. It's a different strategy.
So, but here's the thing. The core of the strategy in these firms is a little bit like a fingerprint, right? You've built a job for yourself that you want to do. You're talking about getting out of bed. You're talking about constructing a quality of life where you're working with a certain number of companies where it's reasonable and you're connected and you have an emotional connection, a human connection. When I look at these firms where, now that I've been in the business for going on 15 years, you start to see transition planning, and you're someone who's actually lived through it, where the firm has gone from, one group to another, and it's basically a dynasty, right? The Threshold has survived through a long period. I guess all in probably close to 30 years at this point, right? Do you think that's the right mechanism for firms, or should firms live and die with a certain set of partners, right? Like when you and your current partners are done, should you close the doors and let the people who want to go on reform their own operation? Or because it sounds like so tailored to your interests and your personal perspective.
I think it's a great point. I mean, I think we'd all like to see the things that we've built continue beyond us. But I also think you're nailing it, which is I think it has to be the way that the people who are carrying that flag forward want it to be. And I think that's part of the natural evolution. I give, Tim and John Fisher immense credit for, letting us, kind of remake the firm in a way that worked for what we wanted to do, which was different than I think what got them excited. And I think that's what enabled that transition to be successful. I think there are definitely lots of firms where it hasn't worked. And I think you have to kind of let each generation kind of remake things the way it is. Also, the world's not static, right? I mean, the markets are different, the technology is different, the founders are different.
Seed wasn't even a category when I started. Yeah. There wasn't, the whole class wasn't there.
We have, so within our current portfolio, we have half a dozen companies that are north of 100 million in revenue. We have, private companies that have many hundreds of millions in revenue. There's one of our companies generated north of 20 million of EBITDA and free cash flow.
Amazing.
In a quarter,
wow.
Right? Last quarter. I mean, these would be like companies that were, years post public when I joined in 2004. And so it's just a totally different world than it was before. And, we're seeing all these new innovations like SPACs, right? I was actually just talking with one of the major investment banks this morning about with the companies getting so big now, the range of financing options that become available. Like if you're that cash generative, the range of options of what a bank could structure for you in terms of financing really open up significantly, right? And so, it's just fascinating to watch this kind of evolution.
It feels like we're entering an era where PE and VC used to be. There was a Chinese wall. It was an iron curtain between the two. They never overlapped. It feels like there's now increasing integration of the VC portfolios into the financial ecosystem, the broader ecosystem. Mm-hmm. There's moments where they're taking out clever debt structures, or we never used to see venture-backed companies doing roll-ups. That was really uncommon. And now that's, you have companies like Compass, which are essentially would-be private equity firms, private equity-backed roll-ups, out doing that under a venture flag. In your perspective, how has, the last year or so changed the game? Because you mentioned there's a lot of shifts that have happened over the last decade. Obviously, the last year has been very momentous in so many ways. What have you seen be maybe enduring shifts in the venture game that people need to be thinking about, either as LPs when they're investing, entrepreneurs, or upcoming VCs?
So I would say I got this totally wrong in March when COVID hit, which is I think I think a lot of folks thought that, wow, this is going to be like a recession kind of coming on. And I think it became pretty clear within like a month or two that wasn't the case at all. I think COVID, tech and software in particular, really are kind of changing the world, and in every vertical market. I mean, it would be almost impossible to name a market that hasn't been or isn't being transformed actively by technology right now. COVID turned out to be a huge accelerant of that, right? And so I'll give you like an example. So we have a company in New York, Bento Box, which provides SaaS software for restaurants and hospitality. And when COVID hit, we thought, gosh, restaurants are going to be closed.
Yeah,
this is going to be tough times for Bento.
Right.
Crystal Mobieni, the founder, and her team pivoted some of their product offerings towards things like the takeout and delivery kind of options. They kept a lot of their customers alive, and their business has been thriving as a result. I mean, I never would have predicted the kind of growth they had last year in March, and so they're literally like restaurants that would have had zero revenue options have now pivoted. Fine dining, where they would have never bothered with takeout to any significant degree, right? That totally shifted. One of my companies, the companies in our portfolio that I work with, TalkDesk, is so contact center software, so call center software. Typically, it's a huge market. It's like more than $10 billion a year. It's one of the last areas of software that really hadn't gone cloud. Interestingly, Twilio, which was another one of our investments, sort of really enabled this kind of transformation to cloud. You could see that it was going to go to the cloud. All software is going to go to the cloud over time. But when COVID hit, you can't have an on-prem call center. Like you can't have 1,000 people in a warehouse sitting shoulder to shoulder. Totally. And so, that one was maybe a little easier to call, but like I would say in general, it almost sounds icky to say, because it sounds like war profiteering or something, but I would say like COVID has forced the transformations to happen even faster. And our portfolio, and I'd say across really just the tech industry in general, has been, I think, largely huge net beneficiaries.
You're mentioning,
look at Airbnb.
You're mentioning B2B, like B2C even. We have a company that does sells couches, right? And they've been growing like wildfire for a long time, but not really penetrating the senior demographic. With COVID, they started seeing seniors buying online. Things that just, you don't see that going back afterward after people understand the convenience and are comfortable swiping a credit card. So I agree with you. COVID has been good for tech, but how has it changed venture? The industry, the way we operate, fund constructs. What do you think are the major shifts coming for us?
Yeah. So, when we talked about like us having kind of a small, tight team, one of the things we really value is that, we can talk about every company and every investment opportunity with our full team, right? So we really valued kind of our ability to have these sort of intimate conversations with our investment team. When we weren't able to meet in person, that was a challenge. So we really had to be thoughtful about how we kind of reinvented our internal workflows and processes. So we sort of over-indexed on, okay, we're going to go from one partner meeting a week to two. We have an all hands every Monday. We have with the kind of the full team, including beyond the investment team. We do these we have monthly kind of activities. We've heavily migrated into platforms like Slack, for example, that sort of facilitate kind of that more kind of quick paced communication. Obviously, we're all spending tons of time on Zoom.
Yeah,
I think a lot of that's going to stick. I mean, I think we're still going to want to go back to being able to sit down in a room together and kind of talk about things. So I think there are some of the interactions that happen that are, you don't sort of shoot the shit on Zoom as much as you do in person. And that actually has value, right? Sometimes that's where the really good ideas come from, is when you actually kind of let the brain relax for a little bit.
Mm-hmm.
And so I think we're going to have sort of that hybrid, but I also think that for example, the speed of our execution in being able to make decisions has actually gone up, not down. The Zoom effect of, people you don't have to build in commute time. I'm in San Francisco, I got to make it down to Menlo Park, or vice versa. I actually think it's easier to get people into a meeting than it was before. And so I think we're going to keep a lot of those innovations.
For example, I think we'll go back to an office after this, or will be will you be remote first? What do you think the pattern is for you guys?
I think we'll have an office, but I think we'll be pretty heavily remote. And I think we're going to figure out but all this stuff was like, the ideas were there with like Cisco telepresence and stuff. This idea that, it wouldn't really matter if you were in the room or
but no
not.
one believed it.
I think that's,
Yeah.
I know, but it was too early, right?
Yeah.
It was like, $100,000 for the setup or whatever.
Mm-hmm.
And you had to have, massive internet connection, which was expensive at the time. You have cellular connections now that can support that kind of bandwidth. So I think a lot of that stuff was just too early. And I think now it's going to stick. And I think a lot of people, also, I think people would have been skeptical about, I was skeptical, like, hey, can we really do this without an office? But it's COVID sort of forced, we didn't really have an option, right? It's either that or pack up the shop. And so, but now you see it working. I think people are like, oh yeah, that does actually work. Like,
and it's faster, as you said. There's a lot of benefits.
Like we have, people don't talk about like kind of the back office finance team in venture that much, but it's an important function. A lot of our finance folks would live, like in the East Bay, they have like, an hour plus commute, kind of into the office each day. They've been as or more effective as they were before. And I think we're absolutely going to say to them, hey, as long as you're getting your job done.
Better quality of life. Yeah.
Yeah, totally. Another 2 hours with your kids. I mean, that's a no brainer.
What about geography? I feel like it's been a catalyst for an ongoing change that maybe Tim's vision had ignited at some level a decade prior, right? We're seeing a lot of shift in startup activity around the country, let alone globally. How has that affected your local community in Silicon Valley? What are your expectations? What are you seeing?
Well, I think the thing I think that I would 100% agree with Tim's vision is that there's founders all over the world. There's opportunities all over the world. And that, the startups should exist in every country, every geography, targeting every market. The thing I would question is, why am I the investor to be the right investor for those companies? So I feel like I understand the US. I understand how to target global markets as a US company. But like, I understand that, or at least I believe that my networks and my knowledge are finite. And, like if you take China as an example, I don't believe that I would be an effective investor investing in Chinese companies with Chinese founders, because I don't understand those markets. I don't understand the cultural norms. I don't have the context. I don't speak the language. And so I think I would rather be personally a limited partner, an investor in the best Chinese GPs, than try to be the GP in China myself. And I think, maybe that's, overly conservative, but I just think that there are some skill sets that would transfer, but I think there are more things that wouldn't. And so for us, it's kind of recognizing what are we really great at, and then not expanding beyond that. To me, as an investor, that's kind of like first principles. But I think
does that mean U.S. is the geographical boundary for your firm and how you guys are thinking about it, or does it even become more narrow than that over time?
Yeah. So I think of it as like where the founders are going to spend their time. Mm-hmm. So a number of our companies. So I have, TalkDesk has more employees in Portugal than we do in the US by a large margin. One of my most recent investments, we have more employees in Scandinavia than we do in the US, but in both cases, the founders are resident in the US and spend time here. And a lot of the executive hiring is here. And so, you're also primarily just initially targeting US markets. I think I would be hesitant to invest in a company that was targeting in international markets specifically, as opposed to building a solution that naturally scaled to international markets over time.
What about,
if that makes sense,
a offshore management team targeting U.S. markets that doesn't move to if there was a team out of Paris that wanted to focus on U.S. customers, would that be a fit for you, or would the team need to move to the U.S. as well? The management.
So interesting. So I would be open to it, but I would also question whether I was the right investor for them. And I would probably tell them that. And in terms of like,
cultural
would the
concerns?
Team need to move? That, but also just like, even just time zones and, like, do I have the right networks to support them? You touched on this, would the team need to move? This whole idea of like founders needing to do anything because the VC say so drives me crazy. Like, one of the things I believe really deeply is I've seen every kind of founder be successful or not successful in venture. And the one thing I've learned is that there's no one style that works. There's lots of different styles that work. And I think it is, VCs need to recognize that we're in a support role. We're the support, we're not the stars.
I love that.
Our role, it's really true. And I think we
we're-
need to adapt our styles to each founder, not the other way around. So I play a different role on different boards, and I bring sort of a different me to different companies because it's what works best with each founder. So I have some founders that want to talk almost daily, right? Or in some cases, if they're engaged in some sort of process, maybe more than daily. I have some founders that are like, hey, I'll call you when I need something. I'm fine with both. I think this idea that like, well, we're going to do it this way because this is how I like to run board meetings or whatever. That stuff drives me crazy. The whole idea of like teams would move because venture capitalists say they have to move, like it's nuts.
You're reinforcing my Empathic VC moniker. For
No.
you. Yeah, well, it's great. I think you should go with it. I think people will love it. All right. I want to wrap this up here. You've been very kind with your time and generous. A couple of rapid fire questions for you. I'm going to steal some of those nuggets of wisdom you used to share while I would walk into a board meeting. What's been one bit of advice you would give to young VCs listening? What do they need to know to be good at this job?
I think the biggest one I'd say is that whole thing about like, we're the support, not the stars. I think the other thing would be recognize that there's a long lag between the decisions and the results, and focus on process and not outcomes. And so I used to play a lot of poker, and in poker you can do absolutely everything right, make the right decisions, and still lose. Not just hands, but like sessions, weeks, months. I mean, there's a lot of variance, and the same is true in venture. But I believe strongly that if you're making decisions that are, let's say, instead of flipping a coin, if you're betting 51 versus 49, over time that's going to work out for you. And so just stick with your process,
unless you're doing low volume of deals.
Well, but I would argue each investment is a series of hundreds of decisions that are chained over time, right? And so, because that is one thing that's really one of the hardest parts about the business is you'll see well-motivated, intelligent, nice, hardworking people still fail, and you'll see people who are absolutely the reverse succeed, and it can sort of drive you crazy. But you just have to make your peace with there's variance in the world. But if you I guess the other thing I'd say is, reputations take years or decades to build and like seconds to destroy. And so, just try and be cognizant of that. And, it's sort of like, Box had one of Box's company values was make mom proud.
That's awesome.
Totally agree with that.
That's awesome. Okay. One bit of advice for founders listening. What do they need to know? And you've been on both sides of this table here as an entrepreneur. And
so I'd sort of split into two. I'd say the first quick one would be like kind of the same thing about the venture, like kind of stick with it. Like it's a long haul. It's hard. I have so much respect for what I did, 3.5 years as a founder, and it almost killed me. I have so much respect for founders who do this for, 10, 15, 20 years. It's never, even if it seems easy from the outside, it's never easy. The amount of stress that founders go through is immense. I'd say, have good support systems, take it easy on yourself. Take care of yourself through the journey, because it's a marathon, not a sprint. And mistakes, you're going to make mistakes. You just need to sort of accept them and move on and learn from them. The other thing I think is persuasiveness. So I think a lot of founders underestimate that the primary role of the founder, as opposed to anyone else in the company, I would argue, is to be a magnet. And you're a magnet for capital, for talent, for customers who are betting on this like company that may, not exist, and that may leave them sort of holding the bag. You're bringing everyone around the vision that you have. And so persuasiveness is really important. So it's not just building the better mousetrap. You have to be able to communicate it in a way that resonates for all those. So one of the things that we really look for is how persuaded are we when we talk to the founder? Like, is he or she getting us excited about their vision? In a way that, in that first meeting, because that's going to be the same with people they're trying to hire and other investors and customers. And so I think, persuasiveness is not, some people are just born with it. It's definitely something you can learn. There are some, there's lots of great, books and training, whatever about it, about just how to kind of, frame things and how to get people's attention. And like when I tended to talk about like my product features, for example, as opposed to talking about customers' problems and solutions, right? And so like that's like a basic one, I would say like remember that your job is to be a magnet, and that's really different than like that. That's very specific to the founder as opposed to like I would argue necessarily the CEO.
As always, Josh, very insightful. Thank you so much for coming on today. I want to give everyone
thanks for having me, man.
Absolutely. Glad you did this. Special thanks to Josh for sharing his perspective on the VC industry. Josh is a great guy and an old friend. I hope you enjoyed the convo. If you liked what you heard, please hook us up with a like or a 5-star review, and feel free to share with a friend. You can find me on Twitter at MPD. And to hear more of my conversations with innovators, subscribe on YouTube, Facebook, or any other major podcast platform. Just search for Innovation with Mark Peter Davis.